Investing Lesson 3, IRAs and 401ks. In this lesson, you're going to learn about individual retirement accounts, also known as IRAs, and 401ks. These are the most common types of investment accounts used to invest money for long-term retirement.
IRAs and 401ks are similar, but also very different. We're going to go over the different types of IRAs and 401k options that you have, and then break down how much money you can contribute to those accounts each year, as well as how to qualify for those types of accounts. And we're going to cover some key information about taxes and penalties that you need to be aware of.
An IRA is a type of investment account that anyone can have, as long as they're working a job where they pay taxes on their income. You can sign up for an IRA through a bank, an investment company, an online brokerage, or a personal broker. A 401k is a type of investment account that's only offered through an employer. Not all employers offer these type of accounts for their employees as a benefit. So don't just assume that because you have a job that your employer offers a 401k. When you sign up for a 401k through your employer, you're agreeing to have a percentage of your paycheck go straight into your investment account. You can determine how much that you want taken out of your paycheck and then have it automatically fund your account each payday, which makes it virtually effortless because things are on autopilot. 401ks became more common over the last couple of decades as an alternative to a traditional pension. A pension is a retirement plan that continues to provide you with a monthly income when you retire. Most companies don't offer pensions anymore, and even the government is trying to phase them out. Pensions are super expensive because employers are committed to providing retirement money to their former employees for the rest of their lives. As you can imagine, that's a huge ongoing expense for employers. The risk and responsibility falls on you to invest in your own retirement. It's up to you to determine how and where you invest your money, whether it's in stocks, bonds, mutual funds, crypto, or whatever. There are a lot of ways to go about it. Before we get into the how to start investing, we need to break down the two main options that apply to IRAs and 401ks.
The first option is called a traditional account. With a traditional account, the money that you're contributing is deducted from your paycheck before taxes and then placed in your investment account. A big advantage to a traditional account is that your money can grow faster because you're investing it before you pay taxes on it. Your gains can grow tax deferred until you withdraw them in retirement, and tax deferral means you don't pay taxes on the money while you're investing, but when the time comes to start withdrawing the money when you're retired, you're going to pay taxes on it based on your income level when you're older. The advantage to this is that a lot of retirees find themselves in a lower tax bracket than when they were working, so they might actually pay less in taxes on their investment gains than they would have during their working years. Another advantage is being able to use the amount that you invested into your traditional account as a deduction when you file taxes each year, which could possibly put you in a lower tax bracket. As you learned in a previous lesson, being in a lower tax bracket allows you to keep more of the money that you earn rather than paying higher taxes on the same income level. A huge disadvantage to a traditional account is that when you finally do retire and you go to withdraw all that money that you earned from your investments, you're going to be paying taxes on a way bigger amount of money than you invested over the years. So in the long run, you could end up paying more taxes than if you just used a Roth account, which is your second option.
With a Roth account, the money that you are contributing is deducted from your paycheck after taxes and then being placed into your investment account. This money is taxed at the same rate as everything else on your paycheck, unlike a traditional account where your money is not taxed up front. The main advantage to a Roth account is that you already paid taxes on the money that you invested. So when you go to withdraw all of that money that you'd made over the decades of investing, those gains would be free from any additional taxes.
One disadvantage to a Roth account is that your contributions can't be used for a deduction when you file your taxes, so it doesn't help lower your current tax liability. Another thing that's important to know is that if you make more than $153,000 a year, you're not eligible for a Roth account. But because the median annual income in the United States is around $44,000, it's probably not going to affect most people. But just know that if you make a lot of money, a Roth account is not an option. If you don't earn any taxable income during the year, such as an allowance or a job that's paid under the table and it's tax-free, then you can't make any contributions to a Roth IRA. However, if you do get a summer job where you have to fill out a W-4 and pay taxes on your earnings, you can put some or all of that money away in a Roth IRA. Traditional and Roth accounts are options for both IRAs and 401ks. When you open either account, you're going to have to choose which type you want. You can use one or you can use both. It's up to you. Now that you know the differences between Roth and traditional accounts, let's break down IRAs and 401ks. A big advantage to an IRA is that anybody can have one. As long as you have an earned income, you can make contributions to it. Which means anyone and everyone who has a job and pays taxes can have one. IRAs have a wide array of investment options that offer more flexibility in what you can choose to invest in than 401ks have. You can invest in stocks, bonds, mutual funds, ETFs, you name it. A huge disadvantage of an IRA is that your contributions in 2023 are limited to just $6,500. That's the max amount of money that you can put into an IRA, whether it's Roth or traditional combined. So whether you want to put all of your money into one type of account or split it up between traditional and Roth accounts, your max contribution limit is $6,500 total. Another disadvantage is that you can't contribute more to your IRA than what you earned. So if you're only making $4,000 a year as your earned income, then you can't contribute more than $4,000 per year. Earned income can be any type of wages, commissions, bonuses, but you can't add birthday money or money that you've earned under the table to your IRA account. 401ks have a huge financial advantage over IRAs. As of 2023, you can invest up to $22,500. Your contribution limits are way higher than the amount that you're allowed to invest each year using an IRA, which maxes out at $6,500. Another advantage is that some employers offer 401k matching. Some match contributions dollar for dollar, while others do a partial percentage. If you have a job where your employer does this, the max contribution that can be made by both you and your employer matching is $66,000 total per year. Now, it's important to mention that the employer can only match contributions in a traditional 401k account, which ensures that the money is taxed when you eventually withdraw it.
A big disadvantage is that you can only have a 401k if your employer offers one. So if you work for a small business or a company that doesn't offer a 401k, then your only option is limited to an IRA, or you can go find another employer who does offer a 401k. Compared to an IRA's huge array of investment options, your investment options with a 401k are typically limited to mutual funds, so your investment choices can be somewhat limited.
If you have the extra money, you can max out your 401k at work and max out your IRA. There's nothing saying that you can't have both as long as your employer offers a 401k as a benefit. And remember, no matter what type of investment account you use, you're investing for the long term. This isn't a savings account that you pull from when you need some extra money. Withdrawing money from your 401k or your IRA before the age of 59 and a half comes with a hefty penalty fee unless you have a special exception.
You just learned what IRAs and 401ks are, what types of options you have with either a traditional or Roth accounts, as well as the advantages and disadvantages to both. Hopefully by now, you're fully aware that your retirement is your responsibility and nobody else's. It's up to you to start investing in your own future. In the next lesson, we're going to cover the advantages and disadvantages of investing on your own versus hiring a financial professional to do it for you.